during the global financial crisis, most advanced countries entered the worst recession they've experienced since 1945, right? And we're talking the US, the UK, the Eurozone, and of course Japan as well. And as they were in the middle of this recession was really caused by excessive levels of private sector debt. All right? Households were heavily indebted. In the US, household debt to disposable income peaked at 130%. The sustainable cutoff is 60%. They were at 130%. In the UK, it peaked at 175%. This is just household debt to their disposable income. So that puts it in perspective. So excessive levels of household debt. Companies were too leveraged. Companies were too indebted. And you all know the story of the big evildoers. Banks were too indebted. All right? That combination, especially when banks are involved, becomes excessively toxic. So they tried to save themselves from probably the worst financial crisis we've seen since the Great Depression. And the best way to do that was through a combination of fiscal and monetary policy. They undertook fiscal policy, they undertook stimulatory fiscal policy, they cut taxes in an attempt to give their private sector some relief and the hope that it will recover, and they stepped up government spending so that there was at least a little bit of demand in the system while everything was shrinking. Something to compensate for the suffering and damaged private sector. But of course, as government spent more and its tax revenue collapsed, it had to borrow a lot of money. And they were running deficits, budget deficits, of between 8 to 12% of GDP. 3%, just like with the current account, is the cutoff, right? 3% is your cutoff. So they were borrowing money and adding to their government debt, which carries interest, which just ballooned. So they exhausted fiscal policy. They did so in the US, they did so in Japan, they did so in the Eurozone. The Eurozone felt that far more acutely than the US did, but they exhausted it. But the one thing they had at their disposal that they could keep going on with was monetary policy. And they undertook very aggressive monetary policy. They cut interest rates to near zero, and the US interest rates are at 0.25%. And the UK, it's at 0.5%. The Eurozone recently cut their interest rates to 0.25%. And the banks now have to pay to put money at the central bank. The idea is essentially saying to the banks, don't come take risk-averse action here. Lend money out to the private sector, to small businesses, to consumers. We're making it expensive for you to put it in the European Central Bank. So that's an even more aggressive element that came into play at the European Central Bank. So that's in Europe. And Japan has boldly gone where no one's gone before. Their interest rate is zero. Okay? So they did everything they could with interest rates, had no effect back in 2008, 2009. Why? Because the cause of the recession was debt. If excessive levels of debt is the cause of recession, you can cut interest rates to any level. If people have just lost their properties, their houses, their cars, because they had too much debt, cutting interest rates are not going to encourage them to go out there and borrow even more. So that's not a tool of actually reviving the economy. So they had to resort to your more exotic measures of monetary policy, the so-called quantitative easing. Have you heard the term? Okay, which is just the fancy term for printing money. Okay, and boy did they print money. In the US they printed money, in the UK they printed money, in the Eurozone after heavy German resistance they eventually started printing money. And in Japan they are printing money as we speak. No one has such a powerful impact on the global financial markets as the US. And the US Central Bank, which is their Federal Reserve, which is the equivalent of our Reserve Bank. Now, what did the US do? In the heart of the recession, 2008, 2009, they printed $3 trillion US, the so-called QE1. 3 trillion, not billion, trillion. That's even beyond what you can imagine in billions, all right? And basically pumped that liquidity into not only their own economy, but through their banks and through their financial markets into the world economy. All right. Then they had a QE2, which was another $600 billion US. Then they had Operation Twist, which was an indirect way of printing money. Then in August 2012, when their government proved completely incompetent and waited to lift their debt ceiling to the 11th hour and gave the markets a complete scare, the US Central Bank said, okay, we give up. We will print $85 billion US a month until the US economy takes off. and until US unemployment comes down to 6.3%, which they did. But by May last year, it was clear that the US economy was getting stronger. US consumers' finances were slowly improving. US companies were actually financially strong by then. US banks were financially fit. Okay, so the US economy was starting to look a lot more solid, especially in the private sector. And the central bank then sat, they had a long discussion and came to the conclusion that you can't keep printing money at that pace if your economy is taking off, because that can become inflationary. So they made the decision they were going to start to taper the amount of liquidity they provide to the market, the amount of money they print on a monthly basis. They started in December last year. That was a very important change in global monetary policy. So they started to cut it by 10 billion every month. They are now down from 85 billion liquidity injection every month to 25 billion. If they continue at this pace, by October, they will add no more liquidity to the system. By that time, US monetary policy and monetary conditions will neutralize. Now, the first thing to consider is at that point there will be less dollars in the system. If you're not printing 85 extra billion dollars, there is 85 billion dollars less in the system. What should happen to something if it is more scarce? The price should go up. So the dollar should strengthen. Right? That's the first thing. The second thing to consider is if you've got less liquidity in the system, that means there is less capital in the system. What is the price of capital? Interest rates. So what should happen to US interest rates at some point in the future? It should go up. Right. At the point where US interest rates go up, you are saying to global investors, for taking absolutely no risk of default, none whatsoever, I offer you a higher return. Would you take it? If I said to you there was no risk, but I offer you a higher return, would you take it? Yes, you would. The clever people would and the stupid people would. Everybody would. Okay? So basically, that is when all emerging markets will be at their most vulnerable, is where US interest rates go up. Because suddenly the equation alters. After the global financial crisis, US interest rates were ridiculously low. It was an impittance to put your money in the US. You earned virtually nothing. After adjusting for inflation, you've given your money away, as the Dominee said earlier. You know, they just gave their money away, investors. They got no return in inflation-adjusted terms. But nonetheless, okay, that was then. And at that point, everybody came to emerging markets. Why? Because A, they were growing faster. Most emerging markets were lifted up by China as China started to accelerate. So they were growing faster, better profits, better earnings, and at the same time, of course, they all still offered positive real interest rates. Positive real interest rates. So there was that search for yield that brought capital to emerging markets. And in fact, we saw a wall of money leave advanced countries and come to emerging markets, which propped up our currencies, propped up our equity markets, and so forth, and so forth. Now it's starting to alter, and we already saw, I said, okay, you can leave it there. I will use it when I need it. No. Oh, no, I'll try and contain myself. All right, so basically, we're already seeing that happen. When that announcement was made, the speculative money, the smart money, started to shift at the margin, out of emerging markets into advanced countries. Waited for the price gain in advanced countries, sold, come back to emerging markets, come and get the interest rate gain. You understand? So there was this back and forth. But on the margin, money was leaving emerging markets and going to advanced countries. And that's why in late last year, the rand took a tremendous knock, if you all recall. In January, at the beginning part of this year, the rand lost 10% of its value in 1 month. And then it stabilized, and it sort of pulled back, and it had spells of weakness, but generally it's been a little bit more stable. Okay? But it's all about trying to play this risk-return game in terms of global money. But that will all change once US interest rates go up. Because then it's not just going to be the speculative money moving out of emerging markets to advanced countries. Then it's going to be the passive funds, the so-called stupid money I was referring to. I don't mean it as an insult. But those are the people that are investing in money market funds and in equity funds and in bond indices at, say, Citibank. And they had their money in emerging market bond index, and they now want to move it to an advanced countries bond index. So when those big funds shift, that's when we'll be at our most vulnerable. So just to show you how low US interest rates are, there you go. Okay, it's incredible. There's US inflation. So in the US, they've had negative real inflation-adjusted interest rates, credit has essentially been free for an extensive period of time, right? This has to change. But that change will come with disruptions, especially for emerging markets. And the moment they announce that they're starting to normalize monetary conditions by adding less liquidity, can you see what's happened to, this is your Morgan Stanley equity indices. So they take all the equities, all the stock exchanges of the globe, and they group them between emerging markets and advanced countries. And they see how they shape up. And you can see that funds have been shifting out of emerging markets into advanced countries. All right? Favoring advanced countries and disfavoring in relative terms emerging markets. But emerging markets are still holding steady. If you had to draw a trend line here, it would just be flat. It's not falling. What we're saying is when US interest rates move, it will start to fall. That's when you start to feel the strain. Okay? And really, it is this movement of money out of emerging markets to advanced countries that explains the rand completely. Foreigners are still not responding to our current account deficit being at 6%. We just feel it because our current account deficit is 6%. We need the foreign capital, so when they go out, we feel it immediately. But that's not been their biggest driver. They're still not responding to the fact that your big sovereign risk rating groups, or international rating agencies, as they call it, these are your Moody's and your Standard & Poor's and your Fitches that give international investors some advice, a rating on how a country fares as far as they're concerned in terms of risk. Has the risk increased to putting your money in there? Has it decreased? Now, if your rating gets downgraded, the risk is increased to putting your money. Now, South Africa has had significant sovereign risk downgrades since 2012. And it is very, very significant from the rand's perspective. But nonetheless, it really is just this movement from developed market funds to, from emerging markets back to developed markets, the difference and the flow of capital that drives the rand. Look at the difference between emerging market investment versus to developed market assets, okay? This shift I showed you, okay? You just take your emerging market equities relative to your developed market equities. That's all you take. You take the difference, there it is. You put that against the rand and it explains the rand's movement almost exactly. Right? So this is an exact match to what is happening to the rand. So foreigners haven't even calculated yet fully that we're not growing, that Able have been bailed out for no good reason whatsoever, that we have a frightening new political party that has their own little uniform and an interesting hat, hell-bent on scaring the life out of all of us. Because they've not even put these pieces together yet. So, but it's when US interest rates go up, though, they suddenly start to look at emerging markets a little bit closer. Understand? You say, well, Malaysia, they've done this and this. They're looking quite good. Ooh, South Africa. Ooh, what's going on here? You with me? And that's when the risk start to rise. And the only way you keep the money in, really, is by offering a higher return, which is what? Interest rates. So interest rates have to go up to compensate for the higher risk. This to show you the rand is still oversold. The rand is still oversold, even after the recent sort of consolidation. Based purely on purchasing parity basis, the rand is still oversold and should therefore pull back. But a weak rand, this is where the Reserve Bank dilemma comes in. The weak rand has a significant impact on inflation. Here you see periods of rand weakness, okay? Above the line, periods of rand weakness. And whenever the rand is weakened, what's happened to inflation? With a lag, it rises. Whew, that was bad. This was exceptionally bad, okay? And this is what's happening now too. It's been a lot longer to come through. Why? Because growth has been weak. And retailers don't have pricing power. So they just have to absorb the cost no matter how much it kills them. Because demand is so weak. But as the economy recovers, what will happen? They will push that cost through so quickly you won't see daylight. It will be like a lightning flash. And the Reserve Bank knows this. So the rand has a powerful impact on inflation. They can't ignore it. And at the same time, they know we're running a current account deficit. We need foreign capital. They know the risk of putting your money in South Africa has gone up. They can't control risk, can the Reserve Bank? No, they can't make the government run the country better. They can't make the economy grow faster. All they can control is the interest rate. So they have to up the interest rate to offer a better return for the risk it's taking to deal with this inflation problem coming and with the vulnerability of the rand. So that's what we